Welcome everyone, welcome again to Hidden Truths. Today we have Josh Barone who is going to speak about a very important topic. It is the environmental, social, and governance investing, also called ESG. Hi Josh, how are you today? Let's discuss that topic that seems to be very important to you because a lot of people are selling ESG and a lot of people feel like they have to because their inner innate goodness and their generosity are being challenged. So let's discuss that.
I always like to say ESG, it's a Wall Street story. It's not a story about your personal goals at all. ESG is, now it's funny because ESG, there are a few good players out there that know what they're doing, but they don't pick up some of the full mandate. They're very environmental. And I want to preface this whole conversation. I'm an outdoor person. I'm very into the environment. I do believe that you have the right to invest in whatever you want, such as capital markets are supposed to be this way, free capital markets, do what you want. But what I'm going to tell you here is that ESG is very marketed device, and it was not invented by Wall Street, but perfected by Wall Street. There's a couple reasons why ESG is so popular right now. If you remember about 10 years ago, robo-advisors were really popular. That the so-called the computer does things for you. Why pay an investment advisor? Why pay an analyst to do anything? The computer can figure it all out. And so ESG was the answer for Wall Street to get you away from going to low-cost product into a higher cost product, because your values say that you should be investing in this stuff. But really, it's just a marketing scam. I know, Catherine, that you're in marketing and you understand what emotional intelligence is. This is just a really good play on emotional intelligence. When we talk about emotional intelligence, I always like to use the company Tom's, right? My wife would go out and buy Tom's and she wouldn't understand why I'd get really upset with her when she came back. And I said, we paid $40 for a pair of shoes that cost $5, but they're going to send another pair to Africa. That's great. They got the tax write-off, I didn't. And so that's what I would say to her. But in reality, what would happen is they would send shoes to Africa. They were resold there. They weren't given away. And then they put out of business all these cobblers that made a lot of money. That's how their living was in Africa. And if you talk to people that do stuff in Africa, they'll say that it was a total sham what they were doing. But they played on your emotional intelligence, and they got you to do something because it felt good to you. That's what ESG is. The other thing you have to know about Wall Street is after long-term capital management, this is a company that was full of brainiac, PhD, mathematicians, and economists who basically started using the first algorithm type people, quantitative people in the market. Now, long-term capital management went belly up, but the process of what they did has really changed Wall Street ever since. Think about it as the guy that invested in Facebook and invented Napster and Tower Records. Why Napster went out of business, Tower Records was never the same. It went out of business after because they basically changed the whole business model. And that's what long-term capital management did. And why that is important with ESG is when we start looking at ESG, you'll understand that it's not really data-driven, and hence why you can't replace it with a computer, but there's still a lot of problems in it.
It addresses a lot of social challenges that seem to be rampant out there, and people become more vulnerable. They don't know, and they are guided to take specific actions that they think is going to make a difference for someone else.
It makes them feel good. That's the whole idea of emotional intelligence. You feel good about purchasing something. And I understand that. I don't particularly like to be manipulated that way, but I get that people want to feel good about purchases and that kind of thing, and they should. So let's kind of dig in here and let me go through what ESG is. And basically what ESG is is a set of mandates. They're essentially analyzing a company and they're looking for a set of mandates in that company. The environmental mandates, and I'm just going to read a list here off a piece of paper because it's much easier for me. The environmental mandates, one, publish a carbon or sustainability report. The corporation has to publish this report. Two, a company that limits harmful pollutants and chemicals. Three, seeks to lower greenhouse gases emissions CO2 footprint. Four, uses renewable energy sources. And five, reduces waste. So these are the principles of the environmental section. Of those principles, I can't quantify any of them. I guess I could quantify their greenhouse gases if they publish that, but they don't. And so there's really no data in this section to quantify, to run down and actually do comparisons, equal comparisons to companies. And this is a problem with ESG. Let's go through the social section here. Number one, operates an ethical supply chain. Number two, avoids overseas labor that may have questionable workplace safety or employment child labor. Number three, supports LGBTQ plus rights and encourages all forms of diversity. Number four, has policies to protect against sexual misconduct. And number five, pays fair living wages. Again, a few of these things we can quantify: living wages, what their minimum wage is, if we're looking at a company that pays minimum wages. Sexual misconduct. If you're a corporation and you don't have policies for sexual misconduct, you're not going to be a corporation very much longer. So I don't really know if that really says anything. Avoids child labor. I think that supply chains at this point know better than that. Every so often you'll get a company that didn't know or didn't check their supply chain. But what you get is supports LGBTQ communities. That's kind of messy because do you remember Netflix with the comedian? I can't think of his name right now, but and then the whole LGBT community got all upset with Netflix, started quitting their jobs. In a time when with the military, where we say don't ask, don't tell, is corporations are the same thing. I don't think as a corporation, I would want to go around and say, hey, are you a member of this community to my workforce? Why diversity is a completely different subject. I don't know if that these things are actually geared towards anything. And again, very low quantifiability of these things. I can't put numbers to them and compare all the companies to each other. It's very, hey, I like this company because they have these policies. Mm-hmm. So let's go on. Governance. Embraces diversity of board of directors. Number two, embraces corporate transparency. Number three, splitting the role of CEO and chairman of the board, and has staggered board elections. Now, there is some data here, so you can actually quantify this, but the data is limited. So when I say that data is limited, when I look at the data that I can see in corporations, I can tell you how many women work for the corporation and how many women are on the board. A lot of this governance section is based on these two factors. How many women are on your board? And that's supposed to be diversification of your company, or if you have 50% female employment. Now, I'm not against any female employment, but I don't think that represents complete diversity in the sense that you want it in a governance section for efficiency in corporate management.
So who are the leaders? So
there's 4 or 5 companies that really got into trying to quantify ESG. And there's a company called Sustain Analytics. Now, I've read the white papers and I understand their algorithms in Sustain Analytics. That was bought by Morningstar, MSCI, Refinitiv, and ESG Analytics, and then, of course, Bloomberg itself. What I found interesting is they're fighting with each other. So Bloomberg came out in December of last year, or in 2021, excuse me, and basically came after MSCI saying that their ESG was nothing more than a tech fund, and that there was all kinds of problems in their in the way they were quantifying ESG. It's pretty funny because when I look at Bloomberg's quantification, theirs is in the same place. And so a lot, there's another thing going on in Wall Street here that we need to talk about, and that's passive investing. A lot of these ESG funds are passive, meaning that the computers kind of run an index and then they give you a model of that index, right? How do you build a passive index when 95% of this stuff is qualitative, not quantitative? It becomes very hard. Of the money going into ESG, I want to say more than 3/4 of it are going into these passive investments. Bloomberg came after MSCI, who's a big index provider, and said, the funds you're running don't really represent the values that we have in here. And in fact, this morning I saw an article where I think it was the state of California or another state, maybe it was Texas, was looking at their ESG investments and noticed that every one of their funds had some kind of fossil fuel company in it, which is fine. Let's dig into sustained analytics algorithm here. And it's going to be very light because we're talking about math that is pretty advanced. The basics of their algorithm is, okay, so you're looking for a company that has these standards. What they do is they penalize industries. So if you're in the fossil fuel industry, your industry gets a big penalty. To buy a company that's ESG in the fossil fuel industry, you have to overcome that industry bias. And that's great. How do you overcome the bias when the rest of it is all based? Most of it's based on, they take what they can, mainly governance, how many women you have on your board, and then compile a list of companies that at least meet that standard, and then they have an analyst go through it. Well, Wall Street's been getting rid of analysts. They haven't been hiring analysts. It's a dying job in the industry because the computers are all replacing it, thanks to long-term capital management. What happens is after they scan down a little bit, they start looking at companies, and then the analysts start putting bias on them. I really noticed a lot of bias effects when they started the ESG started not liking Boeing a couple years ago after the 737 MAX scandal. Socially, that's probably correct. They were doing things that weren't exactly up to par and standard in the industry. But what I saw coming out of the industry was these really heavily biased things. This is before they really got into what was the cause of the 737 MAX, of how could they let this plane go out and what was going on and everything else. Having some aeronautical background, I was just like, you don't know. That's what the whatever the board is called. That's what they do. Why can one pilot get through it and another pilot can't? And typically, if you see a pilot that had the same problem and can fly through it, and another pilot can't, they would call that pilot error because one can do it, one can't. And so what I found is their analysts had no understanding of the aviation business, but they're passing judgment on a qualitative way of the company. In my opinion, if you're going to pass judgment on, say, a retail company or an airplane company or a fossil fuel company, at least you should have industry experience. You should know what's going on in that industry. You shouldn't be lame looking into it going, hey, I just don't really like the news flow. And that's what I really found out is that ESG, if you have negative news flow, they don't like you. If you have positive news flow in terms of their overlying bias, they like you. But what we find is that most companies can't overcome the industry bias. And so ESG funds are mainly tech company focused. So Google, all these companies, and basically Bay Area companies, Silicon Valley companies really fall into these categories. What you get if you're buying a passive ESG fund is essentially you're getting a tech fund. Tech companies, and it makes sense, right? Tech companies aren't manufacturing anything. They're not using dirty chemicals. They tend to be very socially aware because they're in Silicon Valley and they have all these alternative work kind of environments. It's just the gay community tends to live more in California than anywhere else.
I seem to fit the stereotype, and this is what people have a tendency to fall into, right? It's their comfort zone. It's what they've heard. It's what they understand. But it's that lack of education on the topic that makes them fall for those scams or those very attractive offers that they feel like they cannot reject.
You had to break my arm to really get me to talk about this topic because, again, it's very polarizing topic. And what will happen is somebody hears something and doesn't take it with the full context of, hey, then they might not like me because I'm preaching, maybe they think I'm preaching against some of this stuff. But that's not really what I'm saying. What I'm really saying is that there's not enough data to really make this work. And so it's in its infancy. As the data expands and they get more and more data so that we can take this into a quantitative fashion and really compare apples to apples, then it will behaving much more appropriately than just being a giant tech fund.
Don't you think most people, though, are not seeking the data, that they make an emotional decision that because, first of all, they don't have the time to seek the data, and second, they don't want to?
I think you're right. And again, it's why it's a very marketed product. It's very easy to go out to say somebody, hey, we're going to invest in what you believe in, these values, right? And then throw them into an ESG, passive ESG fund and said that you did your job, right? It's very easy to do that. It's much harder to actually go and say, look, we know this is all passive. We're going to have to go out and actually do the research, do the analytics to find this stuff, and not just find the stuff that a junior analyst is telling me is good, but to really get down into it and say, hey, is this a good company at heart? Do they actually do they're saying they do? And maybe they're just catching a bad news flow as they're changing or something happened, because things happen in this world and nobody's perfect. But let's talk about diversification, because I want to get into that, because there's an older book and the book's called Crowdsourcing. And I think it was written by a guy named Jeff Howe. I remember reading this book, and I probably read this book almost 20 years ago at this point in my life, but things go by fast. And it really was profound in his thinking. And basically what it's saying is diversity is not how many women you have on the board. It's not how many ethnic people that you have on the board, although that helps. It has more to do with a thought process, how these people think. If you have a board made up of 10 women and 10 men, and they all went to Yale, you don't have a lot of thought differentiation there. You lack the ability to solve problems because everybody's coming at the problem at the same direction. The idea with crowdsourcing is, say you have a company, you want an engineer, you want a finance guy, you want several different people with different kind of thought processes. And it always comes back to marketing, where you have that chart where you have amiable and the 4 different thought categories on it, right? And what you're doing is filling up the quadrants in your board. So you have all these different kinds of thought and different bases of their thought process so that you can solve a problem. Not, hey, I got 4 women, I have 4 men, we're going to call that diversified, or whatever else you want to call it. If you're hiring the best people and you're looking for these different ways of thinking, you will solve problems much better. I do believe in board diversity. I really do. But when I look at a board, I look at the board and I look at their backgrounds. And if they're all lawyers, then there's no diversity.
That's very important. Obviously, I don't know if most people are thinking that way. I think it would be in their benefits to think that way, to have diversity of education, of background, of experience. Makes them stronger.
The other way you can look at it is, if you grew up poor, you definitely think a lot differently than if somebody who grew up rich, even if you had the same education levels. That's the point, that true diversity is quantifiable. It's just not quantifiable in the terms of the data that we can get our hands on today about corporations. ESG is heavily skewed by the analysts. If you think about it, a company like a robo company, or a company like Betterment, who was allowing you to do a lot of things simply with computers, robots, it makes sense. Now you're back to a very heavily personal opinion of an analyst and to get the answer. So you should pay for that, right? And so they can charge, the fees on ESG tend to be a little bit higher because they got to pay for all these people, right? And that's fine. Although Wall Street's gone the other way and has gone to less people, more computers, hence why BlackRock is a $3 trillion institution with very low, they own all the passive EFT funds. I know a lot of this came up. Let's talk about what we heard with Jamie Dimon the other day in his meeting, the Banking Oversight Committee. I found this interesting because you basically had somebody, Representative Tlaib, I think is how you say her name. If I mispronounce it, I'm sorry. Basically coming after him over climate change and that the banks should basically stop lending to fossil fuel companies. His response was, absolutely not. That's the wrong thing to do. It would lead America on a road to hell. That's basically what he said. A lot of people talked about how that seems very anti-ESG, but then you look at what JP Morgan's doing and they're essentially greenwashing their company. They're very big investors in a lot of these philosophical stuff. He's basically saying that if you legislate it, okay, so he's out there saying, if you legislate it from a congressional level that we can't do these things from a banking standpoint, you're really forcing this country into a road of despair because, look, petrochemicals are in everything. Every product is moved from one place to another that involves petrochemicals. If you went to all electric, that still involves petrochemicals. You're still moving things around. There's still chemical processes that have to be done. You need electricity to make electricity, that kind of thing. Basically, by cutting off these other industries, and I can name a million industries that ESG won't go near, chemical industries, fertilizer industries. These are vital to the American economy. I think that's what he was getting at. It's okay to leave it as an investment process, and if America wants to go that way, that's their right to do. It's their capital. But to regulate it at a point where you're basically saying you're putting these companies out of business because essentially they don't follow your value schema, I view that as a little bit anti-American.
Makes sense. Again, what you just mentioned here is that, first of all, make sure that you learn where the information is coming from, that you base your decision on information that is valid or based on data, and try not to be too emotional.
I think we were having a conversation actually the other day where we were talking about Wall Street and numbers and investments. And I very much laid it out. This is very much a science. It's not really an art. Economics and money management is really about the science of understanding all this data that's coming to us and then projecting it forward to know where we're going from an economic standpoint. And ESG should go that way too, in my opinion. And again, I just think it's in its infancy. And I think as the data comes out and some of these principles are worked out, what they're trying to tell you is if you carry these principles, your company will end up more efficient and more profitable because these principles lead to that. The positioning of ESG is such that there's data support that you do get more efficiencies. I think it really blows up and gets really big. What I do see as a problem is this marketing technique has brought in a lot of money into Wall Street funds. These funds now have a bunch of scrutinies. There's the Bloomberg expose. If you're into ESG, if you're thinking about it, watch the Bloomberg expose on it because it is very informative of what really is going on here. And really question the narrative right now, because again, when narratives are in infancy, that's when you question them. When they've been ferreted out, there's not much to question anymore. Really think about the direction. But it has changed the thinking of corporate boards in terms of this. That's how much money has come into this. And I don't think Wall Street was expecting that. I think Wall Street was like, hey, we're going to put this out there. We're going to market it. It'll keep people away from the robos. It'll bring money in. And I didn't think Wall Street was really understood how much money was going to go this way. You're seeing these companies do it. I'll mention Bombas socks, Patagonia. I do question some of the reasons why they do things, and then they market out to you like they're such a good company. In the terms of Patagonia, I'm not questioning his goals for the environment, but to come out and say, hey, I gave my company to a foundation that I control, and now I don't have to pay taxes, although he didn't say that. And this foundation, which is by mandate of a foundation, has to give money away, and we're going to give money to these things. I'm such a great person. You're going to have to go a little bit deeper to get a person like me to believe that. I'm doing it for your own financial gain. And hey, you spun it into a great press piece, right? I have no problem with that, but let's call it for what it is. Now, Bombas is another story because the socks they give away mostly thrown away. It is what it is.
They are genius marketers. They know that perception is reality, and they know how to play with people's perception. Because like I said before, most people are not going to dig in. They are not going to try to find out what's the real truth, right? They're all hidden truths. Perfect. Yeah. When you have people like you that question, obviously it makes us curious, makes us want to understand it. And we may become more educated on the subject, or just trust someone like you to tell us, okay, I recommend this or I don't recommend that, and get that second opinion, which makes a huge difference.
I spend every day doing this and I enjoy it. I really do. But most people, I can't see most people wanting to do it. I think some people would like it just because we do uncover so much detritus all the time. And it is interesting. I think there's a commercial going on right now that's trying to tell me the future economy is not just monetary based. It has something to do with our values, thing like that. Wait a second, you're talking about economy, which is, again, when you're talking about economics, you're talking about monies and money flows, basically. There's this secondary thing that I don't know about over here. I've been in the market for 30 years and I've never really seen it. You're just marketing something because you want somebody to follow you. And again, that marketing, you have to say, look, the economy is more than just money. It's about values and all this other stuff too.
There is a wave of sustainability, and when you start talking about this, then you raise interest from millions of people who want to be informed and be part of that trend, because it's the right thing to do, but you have to be very careful at the same time.
I do believe in preserving the environment. I ski. Obviously, if you ski around where we live, Tahoe area, that the snowfall has not been the same for the last 10, 15 years. There is something there, and it's probably quantifiable, so I'm not going to deny it. The weather patterns do change. It's pretty obvious if you look at China coming to the industrial age and just how much pollution they put into the air globally. Obviously, you're going to have a change. You can't just have one country doing it. You have to have global buy-in to actually affect change. And it'll happen. And hopefully the technology keeps up so that we can reverse things as well. I would think that would happen too. That's the beauty of technology.
Yeah, great work, great information. Again, when you don't have the time to educate yourself on all those details and find the real data, or you go to experts like Josh, because they live and breathe this every single day. They are also economists. They have experts on their team. I don't have the time to do this. This is why I turn to them, because they tell me, okay, they guide me, they educate me, which makes me feel a lot safer in where my money is going. It's really important to surround yourself with people like Josh. For more information, you go to Hidden Truths. That today we have a lot of various podcasts and videos that are published on a regular basis that will educate you on all subjects related to money and investment, as well as the economy. You have to be informed about what's going on in the economy, what's really going on, not all the truth that is broadcast on all waves by various media. Anyway, thank you so much, Josh. What it is that you would like to leave with your viewers today?
Again, question the narrative, always question the narrative. Don't believe the government numbers on their face, dig into them, understand how they're calculated, and then use that knowledge and in a productive way for yourself and others.
Great. Thank you so much, Josh. Appreciate it like always, and we'll talk to you next time.
Thank you.